Alright, let's talk about something that sounds like it's from a superhero movie but actually runs the entire global economy. It's called the impossible Trinity, or sometimes the Trilemma. Imagine you're at a buffet, an amazing buffet, a stable, predictable dessert price. Let's call that a fixed exchange rate. The freedom to grab as many cookies as you want from any table, which is free capital movement. The power to decide when the ice cream machine gets turned on. That's an independent monetary policy. The impossible Trinity is the economic rule that says sorry, you can only have two of those things, not three, ever. It's a fundamental balancing act for every country on Earth. So, why should you, a human person who probably doesn't run a central bank, care about this? Because the choice your country makes affects everything. It influences the price of that phone you bought online from another country, the interest rate on your student loans or your parents' mortgage, and even how easy it is for you to get a job. This isn't just abstract theory, it's the hidden blueprint that shapes national economies and, by extension, our daily lives. Understanding this trade-off helps us see why governments make the decisions they do, especially during a crisis. It's like knowing the rules of a game that everyone is playing, whether they realize it or not. This concept forces governments to make incredibly tough choices. Do they want to control their own economy from the inside? Or do they want to create a stable, predictable relationship with the rest of the world? Do they want to let money flow in and out without any friction, encouraging foreign investment? So let's break down the three corners of our trilemma. First up, the fixed exchange rate. This is where a government says, our currency is worth exactly this much compared to another, usually the US dollar. Think of Hong Kong. The Hong Kong dollar is pegged to the US dollar. This creates incredible stability. If you're an international business, you love this. You know exactly how much your money will be worth tomorrow. Next, we have free capital movement. This is the economic equivalent of having open borders for money. It means people and companies can move vast sums of cash in and out of a country with few or no restrictions. The countries in the Eurozone are a great example. You can move your euros from a bank in Germany to a bank in Spain in a heartbeat. This freedom attracts foreign investment, but also risks sudden capital flight. It fosters a dynamic, interconnected financial system. But it also means that if investors get spooked, they can yank their money out all at once. And finally, there's the independent monetary policy. This is a country's power to control its own economy using its central bank. The United States and its Federal Reserve are the textbook example here. You can raise or lower interest rates to cool down inflation or stimulate job growth. It's like having your hands on the economy's thermostat. So what happens when a country gets greedy and tries to have it all? Let's travel back to 1997. Thailand, the epicenter of the Asian financial crisis. For years, Thailand was an economic superstar. It had its cake and was eating it too. Fixed exchange rate. They pegged the baht to the US dollar. This created stability and threw open its doors to foreign money. Foreign investors poured in and a massive construction boom took off. The economy started to overheat. There was a huge bubble in the real estate market. To cool things down, a country would normally raise interest rates, but with a fixed exchange rate and open capital flows, raising rates attracted even more foreign money. This made the bubble even bigger. The Thai government was trapped. International currency speculators noticed. They started betting against the baht, borrowing it, and immediately selling it. This put immense pressure on the Thai government. To maintain the fixed exchange rate, the central bank had to buy up unwanted baht with US dollar reserves. It was like trying to patch a giant hole in a dam. The reserves started draining away. On July 2, 1997, the Thai government ran out of foreign currency reserves. It was forced to abandon the peg. The baht was allowed to float and immediately plummeted. Bankruptcies and market crashes followed. The crisis spread across Asia. It was a brutal lesson. You cannot defy the impossible Trinity. The story of the Asian financial crisis is the perfect, if painful, illustration of why the impossible Trinity is a law, not a suggestion. Countries must choose, and that choice has profound consequences. If a nation prioritizes a fixed exchange rate and free capital movement, like Hong Kong does, it effectively outsources its monetary policy. Its central bank can't independently lower interest rates if the country it's pegged to is raising them. On the other hand, if a country chooses an independent monetary policy and free capital movement like the US, the UK, or Canada, it must accept a floating exchange rate. The value of your currency can go up and down based on investor sentiment and economic data. It lets a country fight its own recessions and control its own inflation. A huge advantage. But it also creates uncertainty. Prices of imported goods and the value of savings can fluctuate. It makes international business more of a gamble. The third option is a fixed exchange rate with independent monetary policy, as China has often done. To make this work, you build walls around your financial system and restrict the free flow of capital. That gives the government immense control, letting it steer development with a firm hand. But it can deter foreign investment. Investors worry about getting their money out. For citizens, strict limits on moving money abroad tie fortunes closely to the domestic economy. Ultimately, the impossible trinity is not just theory, it's a framework for understanding the world. It explains why the Eurozone gave up their own currencies, why China manages its economy so differently from the US, and why financial crises can erupt with sudden force. The choice of which two corners to embrace is one of the most fundamental decisions a country can make. It shapes your car loan, your groceries, and the stability of your job.